Folks, if you invest long enough, you eventually learn that the market has a favorite trick. It takes something good, scares everybody away from it, and then hands it to the people who can still think that is the trick. And right now in 2026, that trick is working overtime. Everywhere you look, the market is being whipped around by forces none of us control. Iran ceasefires, tariffs, court rulings, the Federal Reserve, headlines about what Trump may or may not do next. It feels as if your entire portfolio wakes up every morning and asks one question before it decides whether it wants to live or die that day. What happens if Washington blinks? What happens if it does not? And that feeling is real. I understand why people are exhausted by it. Because if you sit too close to the tape, if you stare at every red candle and every green bounce and every headline pretending to be a prophecy, then investing starts to feel less like ownership and more like hostage negotiation. That is exactly where most people go wrong. They start confusing the short-term auction with the long-term weighing machine. They start treating a temporary markdown as if it were proof that the business itself has become worse. And once that happens, they stop investing and start reacting. I do not like reacting. Reacting is what prey does. I prefer thinking. So before I say a single word about the four names I want to talk about, I want to say something that matters far more than any ticker. Open the chart, not the 1 week chart, not the 1 month chart. Open the real chart. Because if you are buying actual businesses, actual assets, actual claims on future cash flow, then what usually terrifies people most is just a very small piece of a much bigger picture. If you zoom in on almost any great stock at the wrong moment, it looks broken, it looks sick, it looks like something to avoid. There is always a stretch where it appears foolish to own it. That is not an exception. That is the admission price. People hate this part because it attacks the ego. They want to buy the exact low, feel brilliant immediately, and watch the line go obediently upward forever after. That is not a market's work. The market's job is not to validate you. Its job is to test whether you know what you own. And if you own quality assets through enough cycles, the long-term chart tends to look very different from the small, ugly window that everyone is panicking about today. So I want to talk about 4 stocks that, in my opinion, fit a very specific bill. They are well below prior highs. They have meaningful competitive moats or positioning advantages. And most importantly, the decline in the price is not the same thing as a collapse in the underlying business. That last point is everything, because a cheap stock is not necessarily a bargain. Sometimes a cheap stock is just a weak business finally being priced. Honestly, I am not interested in those. What I want is a stock that is down hard while the business underneath it still has a runway, a moat, a pivot, or a market position the crowd is underestimating. That is where opportunity lives, not in obvious perfection, in dislocation. So let me start with stock number 4. Robinhood, ticker symbol HOOD. Now, Robinhood is one of those companies that a lot of people still misunderstand because they are stuck in the first impression. They hear Robinhood and they still think of a flashy trading app, meme, stock mania, confetti, retail speculation, and a business model that exists only as long as amateurs keep pressing buttons. That is old thinking. The business is no longer just that. And if you are still using the old mental model, then you are almost certainly missing what has been happening underneath the stock price. The stock got cut in half from the October highs. That sounds dramatic because it is dramatic. The price to sales multiple got sliced down. The stock got punished. Sentiment cooled. The market lost some of its appetite for fintech stories and for anything that looked too exposed to risk appetite. But here's the part that matters. The business did not get cut in half. That is a huge distinction, because when a stock is down by 50%, people tend to assume the business must have suffered something proportionate. Sometimes that is true. Sometimes the market is simply repricing what it is willing to pay for the same underlying operation, and that appears to be much closer to what is happening here. Robinhood has quietly become much broader, much deeper, and much more serious than the old caricature allows. This is not just a stock trading app anymore. This is brokerage options. Crypto futures, margin lending, retirement, credit card, prediction markets, even venture exposure. More importantly, these are not decorative business lines. They are beginning to matter economically. This is what I watch with businesses like this. not whether they can add shiny features to impress the crowd, whether they can turn users into deeper relationships. That is the real game in financial platforms. Anyone can get a user in the door with a slick interface and a low-friction account opening flow. The difficult part is turning that user into a multi-product customer whose lifetime value keeps growing. That is where Robinhood has gotten more interesting. The Gold subscriber tier is growing. Average revenue per user is climbing. The company is not simply collecting accounts. It is thickening the bond with the accounts it already has. That is a sign of a maturing platform, and mature platforms can be very powerful businesses, especially when the market is still emotionally treating them like adolescent stories. Then comes the thing the market may not yet fully appreciate, and that is the pathway to the next generation. The federal program that positions Robinhood alongside much larger and more established names as a platform for government. Linked savings accounts for children matters more than it looks like it should. People hear that and think of a line item. I hear it and think of brand imprinting. Getting in front of millions of future investors before they even make their first independent financial decision is not a trivial thing. That is not just account flow. That is habit formation, that is familiarity, that is trust being seeded extremely early. And once you understand how sticky financial behavior can become, once a person settles into a platform, you begin to understand why this could have very long implications far beyond the next quarter. Markets are not especially patient with these kinds of second-order advantages. They usually want immediate proof. Fine, that is often where the opportunity is. Then there is management buying back stock. I always pay attention to buybacks when the price has been punished. Not every buyback is intelligent. Some management teams buy back stock because they have no better ideas. Some do it at terrible prices. But when a company authorizes a meaningful buyback after the stock has been cut in half, it is worth asking a simple question. What do the people inside the building believe about the difference between the price and the value? They are not panicking. They are not acting as though the platform is deteriorating. They are taking advantage of the lower price. I like that. So when I look at Robinhood, I see a stock hit hard by sentiment and multiple compression, while the business underneath it is becoming broader, stickier, and more mature. That does not guarantee success. Nothing does. But it is the kind of setup I like very much. Now let us move to stock number 3, Nike. This one is different. Nike is not a new platform story. Nike is not an AI infrastructure story. Nike is not an early-stage growth machine trying to prove it belongs. Nike is a fallen giant. And fallen giants are dangerous because sometimes they are bargains and sometimes they are value traps wearing famous logos. So you must be careful. The stock is trading at levels that take you back to a different era. Years and years of stock market progress effectively erased. That gets my attention. Not because the stock is down, because the brand is still one of the most recognized athletic brands on earth. Now let me be blunt. There are real reasons the stock got crushed. This was not random bad luck. This was not just macro. Management made a mess. That matters. I do not respect the habit investors have of blaming every failed stock on the economy. Sometimes the people running the business simply did a bad job. Nike made serious mistakes. They pulled away from wholesale partners and overestimated how much direct control the brand could exert without damaging its presence. They leaned too hard on the classic lifestyle lines and saturated the market with what used to feel special. They let newer, fresher, more performance-oriented competitors seize ground while Nike was busy milking yesterday. As icons, that is not a small strategic error. That is a brand stewardship error. And brand stewardship matters enormously in apparel and footwear because the intangible value is the thing. The shoe is not just the shoe. The brand heat is the asset. If you cool the brand by flooding the market or by being lazy where innovation is supposed to live, you can do real damage even while the logo remains globally famous. Now here is why I still find Nike attractive at these levels. The market is not rewarding the possibility of recovery. It is pricing in a lot of disgust, a lot of distrust, and a lot of skepticism about whether the turnaround can work. And that is rational. Turnarounds take time. The market knows this. It does not want to pay up today for a fix that may take years to show up fully. I understand that. But I also understand something else. The brand alone is worth a great deal, not in a vague emotional sense, in an economic sense. Distribution relationships matter, global recognition matters, cultural footprint matters, athletic heritage matters. The ability to recover from a management era that mishandled those things is not automatic, but it is very real when the underlying brand strength remains this large. The new CEO matters here because this is not somebody wandering into the building fresh from a consulting firm with a deck full of abstractions. This is a veteran who understands the company deeply. That does not mean the turnaround works simply because he knows the building. It means the diagnosis is more likely to be real. And if you know what was broken, then you at least have a fighting chance to repair it. Now, I do not expect this to snap back overnight. That is not how brand repairs work. The market may be right to demand patience. Wholesale relationships need rebuilding, product credibility needs rebuilding, innovation needs to regain oxygen. Younger customers need reasons to come back. This is work. But when a great brand is this discounted because management spent years misusing it, I become interested, because this is not a case where the core asset disappeared. The asset was mishandled, that is different, and markets often overpunish mismanagement when they cannot yet see the timeline of repair clearly. That is exactly the sort of setup that can produce very good returns over a long enough period if the turnaround is even moderately successful. So I do not look at Nike here and ask, why is it not exciting right now? I ask, how much of the bad period is already in the stock price? And how much of the brand's residual power is still not being respected? That is the right question. Now let us move to stock number 2, Salesforce. Ticker symbol CRM. Now software is in a strange place in the market right now. People are trying to guess which companies AI will help, which ones it will kill, and which ones will simply become less important because the layer above them gets smarter. Whenever the market becomes confused about a sector's future, multiples compress. That is what markets do. Confusion is expensive, but not all software is the same. And Salesforce is the sort of business people underestimate when they look only at the price chart and ignore the pain involved in replacing it. That pain matters once a large company builds a core part of its sales workflow, customer service workflow, support system, and internal automation stack around Salesforce. The idea of ripping it out is not just a line item. It is a multi-year operational disruption that is a moat, not the kind you can draw neatly on a whiteboard. The kind you feel when someone asks whether you want to spend a fortune and risk chaos just to save some software expense. Most companies do not. That is why switching costs are so valuable, and why I like software businesses with real embedding. Now, Salesforce is down hard from the highs. The multiple has compressed sharply, and the market seems to be treating it like one more software name caught in a broad area of fear. Fine, that can happen. But the business has not suddenly become shallow just because the multiple collapsed. The lock-in is still there, the embedded workflows are still there, the customer dependence is still there, and now the company is trying to do something much bigger than simply keep the old software engine running. Agentforce. This is where the next leg of the story lives. I do not say that because I like buzzwords. I dislike buzzwords. I say it because this is the kind of product development that changes the role the platform plays inside a customer organization. Instead of users coming into the system to manually push data around, generate reports, route tickets, or write follow-ups, the AI layer begins to execute more of the repetitive and coordination work itself. That is not cosmetic. That is software becoming labor substitution. When software becomes labor substitution, value can increase dramatically. Now, of course, every software company says something of that flavor right now because everyone knows the market wants AI. But I care about usage, adoption, and proof. And the source material offers exactly what I like to see. Actual transactions, actual deployments, government use cases, health administration use cases, commercial customer use cases. The point is not that every AI project becomes a giant success. The point is that this is already operating in the real world. That matters, because when the market is in broad fear mode, it tends to throw all software names into one bag and ask questions later. That is how opportunities get created. The market sees software panic. I ask, which of these companies actually have the installed base, the switching moat, and the product adjacency to turn AI into a real expansion layer? Salesforce is one of those names. That is why I think the stock is far more interesting down here than people appreciate. Not because the recent pain was imaginary, because the business may be far more resilient and far more advantaged than the current compression implies. Now we get to stock number 1, Applied Digital, ticker symbol APLD. This one is a little different from the others because it sits right in the middle of one of the most infrastructure heavy parts of the AI build-out. If you believe AI demand is real, if you believe data center power demand is real, if you believe high-performance compute needs are real, then you eventually have to stop thinking only about the flashy model layer and start thinking about the physical world that has to exist underneath it. Power, cooling, land build-outs, facilities, actual infrastructure. That is where this company lives. And what makes the setup especially interesting is that the stock is still well below prior highs, even after the company just put up the kind of earnings report that should make you stop dismissing it as a speculative sideshow. The revenue beat was huge, not a nice little beat, a real beat year-over-year growth was explosive. And the market still has not fully repriced the company, as if this is already a confirmed infrastructure winner. That catches my eye. Now, why? Because if you are building data centers designed specifically for AI and high-performance compute, you are not just building generic real estate. You are building for an environment with very different power density and cooling requirements. That matters because it narrows the field. Not every operator can do it well. And the demand side matters even more. The tie to CoreWeave is not a trivial thing. That relationship puts the company inside one of the fastest growing and strategically important segments of the AI infrastructure chain. If you are the operator helping build and run the compute backbone for one of the major AI cloud stories, you are no longer simply hoping that demand may come. You are already connected to it. Then there is the financing model, which I like more than people probably realize. If a company building at this pace constantly issues equity to fund itself, the dilution can crush the shareholder even while the business grows. That is one of the great dangers in high-growth infrastructure names. You can be right about the theme and still get diluted into mediocrity. But if management is financing more intelligently, using the assets and the future contracted cash flows attached to those assets, the way infrastructure is often financed, then the path can be much healthier. That does not eliminate risk. Build-out risk remains. Execution risk remains. Tenant risk remains. But it changes the structure of the problem, and structure is everything in capital. Intensive businesses, the world needs more compute. That much is not in doubt. The question is which companies will actually build the physical base that lets the AI economy keep expanding. Applied Digital has positioned itself right in the path of that answer. And because the stock is still materially below old highs, even as the numbers blow through expectations, the setup becomes very attractive, not risk-free attractive. That is enough. Now, before I bring this together, I want to say something very important about lists like this. The names are not the main point. The setup is the point. Robinhood is a maturing platform being punished more than the business deserves. Nike is a global brand that was badly managed but may be over-discounted relative to its recovery potential. Salesforce is a deeply embedded software giant being dragged down by sector fear, while AI may actually deepen its strategic role. Applied Digital is AI infrastructure with real momentum in the business, while the stock is still not back to old highs. Different sectors, different risks, different timelines, but the same broad pattern: price damaged. Story intact or improving. That is what I look for. Not names making new highs every week. Names where the market's emotional markdown may be outrunning the actual deterioration in the business. That is how I think about buying in difficult markets. Now let me bring us back to the beginning. How do you invest in a world where every headline seems to swing your portfolio by 10%? You do not solve that by becoming a prophet. You solve it by zooming out and by owning quality over time. The people who keep getting hurt in markets are usually not the ones buying bad prices for bad companies alone. They are the ones who keep demanding certainty before they act. That certainty never comes. What comes is volatility. What comes is discomfort. What comes is temporary dips that dip again and make everybody feel stupid right before they become excellent entries in hindsight. That is why I have no interest in waiting for perfect. Perfect is a fantasy that keeps people in cash while good assets get slowly accumulated by people with stronger stomachs and better systems. If you are buying actual quality, if you are scaling in over time, if you understand the moat, the runway, and the reason the market is emotional, then you do not need a crystal ball. You need discipline, that is all. And that is the real lesson in all four of these names. Not that any one of them is guaranteed to work. None is. It is that the market is emotional. And emotion often creates the best prices for assets whose actual long-term value creation is still very much alive. That is what you are looking for. Not comfort dislocation, not consensus opportunity, not a crystal ball, a good chart, a good business, and the ability to tell the difference between a broken stock and a broken company. That is how you survive 2026. And if you can do that, then the push and pull market everybody hates right now becomes something else entirely. It becomes your shopping season.